Welcome to America's Commercial Real Estate Show, your source for intel, forecasts, and strategies. Hello, I'm Michael Bull. Thanks for catching the show and being with us today, wherever you're watching or listening. Well, today we're going to talk about the office market, and we're going to specifically look at office landlord strategies. So if you're investing in commercial real estate or office properties, or you lease any properties, you might find it very interesting. And office has been a little interesting lately, what's been going on. If you look, we've had good, strong job growth in most markets. You know, we've had little to less supply being built in a lot of markets around the country. But then we've had some other things happening with the office market. We've had some companies, a lot of companies looking to use less square footage per employee. We've had people doing telecommuting. So, you know, the market's in a little turmoil. Let's see what's happening today. Well, first we'll talk with CoStar and look at the market. After that, we'll talk with Mike Lipsey, the Lipsey Company, and talk about some strategies for leasing more space, raising your NOI, and the value of your property. Please welcome my first guest, Hans Nordby. He's with CoStar. He's the managing director of CoStar Portfolio Strategies, and he's joining us on the phone. Hans, thanks for being with us.
Michael, thank you so much for having me today.
So, Hans, what are tenants seeing? What are landlords dealing with around the country today related to rental rates and occupancy?
Well, first of all, we're seeing a slowing in rental rate growth, Michael, to 1.7% year over year versus over 5% back in 2015.
Wow.
So that's quite a slowdown. And that slowing in rent growth, it stems from an over 40% spike in new office deliveries this year in 2017 versus 16 by the time all the deliveries are done this year. So to put that in perspective, 2017 is going to be the first year in this real estate cycle, which we'd say started in 2010, when the recovery began, in which net office completions are going to outpace absorption. But since we're at a 10.2% national office vacancy rate as of the second quarter, the office market kind of needs new construction on average. So not as much fun for landlords, but the markets are functioning and they're still very healthy, Michael.
Right. And it's always interesting because, you know, we're headquartered here in Atlanta, and we haven't seen much new supply. We've really seen our rates spike up. But the tenants, you know, around the market, you know, in some markets like Atlanta and some other markets, they're seeing some pretty strong rate growth. So, but you're starting to see it slow down a little bit. So what's that mean for the future for rental rates moving forward?
Well, we continue to see strong 8 to 10% rent growth in some markets, as you alluded to earlier, Michael, particularly the East Bay in California, which is kind of a spillover market in San Francisco and the tech market, but is coming into its own. But that'll slow down because San Francisco rents have already slowed with new construction. Other markets with strong rent growth include Charlotte and Seattle. They're posting about 7% numbers, also strong. Other markets were nationally, office rent growth has generally slowed to between 1 and 3. As I mentioned earlier, 1.7% on average. Most of that's because construction's killing a lot of the upside.
And that's an annual basis, right? Not quarterly.
Annualized,
right.
Yes, sir.
Okay.
But what I would also say is there are some real interesting stories within this. So Houston, for example, New York and San Francisco. So office rents have been in decline in Houston for a while, along with the energy market crash. That's been happening for a while, but this is the first time this cycle for the central business districts, CBDs of New York and San Francisco, where we've seen a 1% year-over-year decline in rent. So even in New York and San Francisco, the two investor darlings in the country, the leading ones, we've seen a decline. New York, the reason for rent stems mainly from the high level of construction and generally kind of soft tenant demand. So it's not just construction. So, for example, New York now has 21 million square feet of office construction underway.
Wow.
And that's about a 10-year supply of new space, given the fact that net absorption in the market's averaged under 2 million square foot annually for the past 5 years. Now, it's more complicated than that. It's not going to take 10 years to absorb this. There's ups, there's down. You know, we're not forecasting a very near-term recession, so that average includes recessions. And there's also the conversions of old office buildings to residential, which will take some of the inventory out. But net, that's a fair bit of supply for New York. Other markets that we see, San Francisco, construction activity is even more aggressive. Since the 9 million square foot of in-process construction is a 5% increase in the office stock, which is more than double that in New York and on a percentage of stock basis. So for tenants and for landlords, this changes the game. For tenants, the increase in new supply nationally has given more buying power back to the tenants, especially relative to 15. However, that plays out differently in some different markets depending on where you're sitting.
So let's talk about that. So relatively speaking, of course, you can get a good deal in New York if you're a tenant today. But where are some other markets where tenants, maybe a corporate headquarters or a larger tenant may get a good deal?
Well, it's interesting you should say that, Michael, because when you say corporate headquarters and major tenants, they hit the news. Generally, they look for such large blocks of space that it comes down to the number of large blocks of space available. Some markets around the country, you mentioned Atlanta earlier, but several around the country, San Diego comes to mind, and some other markets have relatively low levels of construction. And that doesn't just hit your nominal vacancy rate, although it does, but it also means there are fewer large blocks available for a large tenant, which means you're more likely to get build-to-suit activity. And in a lot of these markets, they're build-to-suit type markets. So if you look at Minneapolis or San Diego or Atlanta, they're the types of places that quite oftentimes a big corporate tenant says, hey, I can find a space. It's not like San Francisco where it's no end of litigation to get the zoning and a long timeline to get it built, and you'll see kickoffs of build disputes. We saw that in Houston several years ago when the oil market was so hot. So I think, to your point, some of those big tenants are going to start kicking off in markets like Atlanta, San Diego, Minneapolis, because they're big tenant markets. They tend to have Fortune 500 firms, not so much San Diego, but the other two. And there aren't that many big blocks of space available. So while construction activity in terms of inventory underway has pulled back a little from 147 million square feet underway at the end of 16 to about 143 million square feet in the pipeline today, we could see some lumpy stuff in any number of cities that'll cause some pops.
Right.
Hope that's not the 20-minute answer to your 1-minute question, Michael, but that's how we see it.
Yeah, well, that's great. We're talking with Hans Nordby. He's with CoStar. We're talking about the U.S. office market. So, Hans, what are some of the factors that are really impacting the office market moving forward? You mentioned new supply levels in some markets, but what else might impact the market moving forward?
Well, the magic asterisk here is that we're assuming no recession. We are 8 years into an economic cycle, and on average, economic cycles are supposed to last 5.7. So that's, this is a little long in the tooth. Now, from what we see, and you mentioned at the beginning of the call today, Michael, job growth has been quite good. And in addition to that, corporate profits have been rising for a couple quarters in a row. They were rough about a year ago, but they've been rising 3 quarters in a row. Leading indicators are generally positive. Energy prices are low, makes it a lot more livable for Americans and helps their spending power. So we don't see what's the precipitative factor in a recession in the next year. But if I'm a real estate investor and manager, as your listeners are, I'm watching out for that next recession. And I would bet on it happening, 2.5 to 3.5 years out. So that's something as a landlord I would watch out for and try to move more towards, longer leases and better quality tenant. So that's a major trend, but it's kind of hard to put your finger on this week. You also mentioned at the beginning of the call, lower square foot per worker. Yes, that's important, but I think that's slowing down a little bit for a couple of different reasons. One, we see it in the numbers in terms of the decline in the number of square feet per worker in many markets. And I don't have the specific number for Atlanta in front of me, but recently we saw Atlanta square foot per worker stabilize and maybe even tick up by half a foot. Well, this is for a couple different reasons. One, the unemployment rate in the 4% range, that's tight. It's hard to get people that you actually want. They've already got a job. One of the ways you get people is you have high-quality space and you don't stick them in a shoebox. So that is a pushback, especially in a market like Atlanta, where while rents are up, they're not out of hand compared to a San Francisco or a New York. So it's not that expensive to put your people in good quality space. So that's a mega trend that I think is playing out depending on which market you're in, a lower barrier, higher vacancy, lower rent market, or a very, very tight market. And the second thing that'll affect all markets is demographics. You know, the millennials, their peak year is 1990 for their birth year, so on average they're 27. You know, when you're 2-3 years out of undergrad and you just got a job, and your idea of privacy might very well be headphones. You know, I'm 50. My idea of privacy is not headphones. Tragically, these people will turn 35. They might do something crazy like move to the suburbs. They might want a whole desk to themselves. These things don't support a lower square foot per worker. So overall, I think there are some other macro trends at work here that, yes, we'll have a lower square foot per worker, but a lot of that's played out already.
Yeah, I think that's a great point, because I think when the economy was not doing well, companies were looking for ways to save cost. There was, people, it was easy to get employees and retain employees. Okay, let's cram them in small space. But now it's tightening up. The job market's tightened up, and I agree. When we do tenant rep in the Atlanta market, and it's all about retention. It's about recruiting. It's about having a nice space that people want to come to work and actually get out of their home and not telecommute and be in your office. Well. Yeah. Hans, what about what would be a tip that you could leave our listeners with for landlords or investors or developers on the office side of the market?
Well, I would go back to what I said earlier. Times are good today. While rent growth has slowed, it's still positive, and vacancy rates are pretty low. And of course, I'm taking a national average here. It's different depending on which market you're in. But as a blanket statement, I would say, you know what, if you think that trees don't grow to the sky, and there'll be a recession in 3 years, I'd get the longest lease terms that you can get your hands on and try and get some tenant credit today. You might be glad you have it 3 years from now.
Yeah, that's a very good point. Well, Hans, thanks for joining us on the show today, and appreciate you being on.
My pleasure. Thank you, Michael.
And stay with us. We're going to have more on the office market. In fact, next we're going to have Mike Lipsy with the Lipsy Company, and we're going to share some great strategies for leasing space and improving your income on your office properties. And this segment is brought to you by Bull Realty, commercial real estate asset and occupancy solutions in the Southeast, headquartered in Atlanta. Visit bullrealty.com. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show. We'll be right back.